Good afternoon, everyone. My name is Sam Tabit. I am from Bamboo Wealth Financial Planning. Today's segment is lost superannuation. This is a very important topic. Please remember to contact us on 1300 855 014 if you'd like to further investigate your lost superannuation. Today we'll be covering the important aspect of why financial planners must consider when dealing with clients' overall financial situation. One of those things we actually cover immediately is superannuation. How many superannuation accounts does a client have? And what is in those superannuation accounts, because that has a significant impact on their overall planning. Okay, so let's look at the next section. Okay, so the next section is looking at facts about lost superannuation. There's approximately $3 trillion in superannuation sector. So a lot of money goes into superannuation through the superannuation guarantee or employer contribution, which represents about 9.5%. According to the ATO, there is also approximately 5 lost super accounts per Australian. So there's a lot of money that's floating around that Australians are not necessarily familiar with. And the other important thing here is that the ATO considers that there's approximately $18 billion that is in lost superannuation that they are trying very hard to ensure citizens or members can find their lost super. The other important fact there is point 4, which relates to your medium superannuation balance. Now, according to the Australian Superannuation Funds Administration of Australia, the average male between approximately the ages of 55 and 64 has about $183,000 in super. And average female has about 118. So what that means is that by the time you retire at that age bracket, you probably will have insufficient amount of money to be able to retire on a modest or a comfortable lifestyle. So it's very important to consider. An interesting fact here that recently, as of last year, a 68-year-old Australian found that she was effectively entitled to $1.5 million under the unclaimed super scheme that the government is offering. Another also person at the age of 65 found approximately $600,000 that they were not necessarily aware of. So you can see the importance of, before we start planning for clients, we investigate what superannuation may be out there that they can take advantage of. Okay, so the next section we're going to look at is, just give me a second. The next section we're going to look at is effectively, how can you find your lost superannuation accounts? So I've got 3 segments here. The first one is mygov.au. Where clients can themselves go onto mygov.au once they're linked to the Australian Tax Office servers. And mygov, you've got the logo there, and that's the email address. Now, the other point is that they can also see a financial planner who part of the overall financial planning offering can do this on behalf of clients. And the other thing that members can actually do is contact their super fund that they are aware of and ask them if they have a lost super function that they can follow. So this is also a very important aspect because a lot of super funds do offer this as a search function, and they don't necessarily charge for this. So do that before you need to pay anyone else to actually do this work for you. Okay, so we'll look at some of the important aspects of why you should seek to consolidate and find your super accounts. But these are 3 ways that you can find them yourself. These are for internet technology and apps and phones. It's not quite hard to link and also quickly find your lost super. Okay, so why do you consolidate your super? So why would you want to consolidate your super? This is obviously a question that clients ask, and some of the things that we go through, there are 6 elements here that I can discuss with you. The first one is fees and cost. Now, fees and cost are, excuse me, just dropping out again here. Fees and cost, well, fees and cost is very important. You might have multiple. Can you imagine you had 5 different types of funds? So administration fees, there are also investment, or what they call management and investment fees, and there's also could be advisor fees. So if you've got 5 different accounts, you may be paying for a service that you're not necessarily getting, or you may be paying for fees, doubling up the cost of fees. So it's one of the things that we obviously try to look at to minimise the fees for the client. Remembering a 1% fee or 2% fee or additional fees and charges taken up from your accounts over 10, 20 years can have significant impact on your final balance. The second one here is investment options. Okay, investment options is also very important. Not all super funds provide you a lot of different types of investment options. Some funds only give you 5 or 6 investment options. Others give you up to 200 different types of investment options. Now, how many investment options you need, it really depends on your own individual circumstances. But certainly, having the ability to choose different options for different circumstances or times of the market or your life is definitely an advantage. So, most of default funds will be included in a lot of the type of employee funds or industry type of funds. But if you have more limited options, then it may not be necessarily in your best interest. The other one is insurance cover. Insurance cover is very important. A lot of funds up until recently, July last year and April this year, cannot effectively deduct insurance from your account. For many years, people have had their superannuation, which often would be small balances as they move from one employer to another and lost track of these funds. Over the years, the insurance premium would have actually eroded the remaining balance and eventually made that fund null with a zero balance. So why do we need to consider insurance? Well, often you can get independent insurance advice. Often you could, as I mentioned, have different types of policies that you can't claim on, or they have limited benefits. So it's important to look at products that provide you insurance features that are best your needs. Now, the other one is quality, advice quality. Not all super funds provide you comprehensive advice. Most funds, particularly the industry sector, have scaled or limited, or what they call intra-fund advice. Other funds, for example, retail funds or independent super funds, may offer you a wider or larger group of qualified financial advisors that can give you more comprehensive advice. So sometimes clients don't like the service that they're receiving. Sometimes clients are not really comfortable with the limited advice, or sometimes the advice is conflicting. So if you go to one particular fund, they're only going to give advice on one fund. But if you go and see a third party like an independent financial planner or just a financial planner for that sake, essentially they can look at different products without having any internal conflict within that organisation. And obviously fees, advisor fees, you need to consider. Also bear in mind with the advice quality scheme, all financial advisors must be accredited, must have a degree, be registered with FASEA, and also must have sat an exam. So always ask those questions of the advisor before you receive any advice. The other one is tracking performance. Some funds tend to be poor performing. Recently, the regulator, APRA, and independent research showed that a lot of funds do underperform the actual market. Market being a major index in the financial sector, so whether it be share market index, property index, or bond index. So performance is very important. So it's critical that you review your funds. And some funds effectively have very limited amount of investment options. Therefore, the performances can be limited. Okay, so it's always important to look at, do those funds provide you a tailored solution for your particular needs or your preferences? It could be ethical, it could be religious, or could be just performance-based. The other one is easy management. Okay, so with easy management, some funds look at providing you maybe a better service. Can you actually take out your money quickly? Do you have different types of investment options? For example, do you have access to shares? Some super funds offer you term deposits. Some have better reporting. Some could be online. Some could be paper-based. And some also may have a larger or smaller call centers. And also the workers in their call center may be either highly qualified or provide you a limited type of advice. Okay, so it's really important that you look at your super funds and choose a fund, consolidate your funds to ensure that at least 1 or 3 or 5 or 6 of these types of points you've made that are important to you can actually be met. Now, remembering with different types of super funds, you have independent rating sites or comparison sites that compare different types of performances. It's really important that when you're looking at tracking performance, this point over here, that you're comparing apples with apples. when we say apples with apples, so it has to be like for like fund. It cannot be a fund that is significantly different in the way the investment options are actually put together. Okay, so it's important that you do compare like for like and don't just look at the end result, which is the return, because the higher return you are receiving from a fund, obviously you're taking more risk. To give an example, when you look at most of these types of funds, according to the ASFA, ASFA does show that most Australians who invest in my super funds being funds that you don't choose, you are giving automatically if you don't make an investment option, you're not engaged within your superannuation. So most people, on average, will have a balanced portfolio. What that means with balanced portfolio is that you'll be approximately having about 50% of your money invested in the Australian share market and international share market. Now, when we get share market corrections or falls like we have had recently in March 2020, this could have a significant negative impact on the performance of your fund, short term and also possibly long term. So it's important that, again, you compare apples with apples. What that means is, does the asset allocation of your fund reflect the level of risk that you're willing to take, or you understand that you're actually taking? Okay, so these are in summary why you would need to consolidate a superannuation. These are good points for investors to consider. So again, if you need particular advice, contact Bamboo Wealth. We'll be able to make sure all these options are actually considered and to ensure that the fund that you choose meets your long-term needs. Okay, now let's have a look at the next section. Excuse me. Okay, so why do you need to know before consolidating? Okay, what do you need to know before consolidating? So the first point we talked about here before is before you decide to move, for example, let's say you have 5 funds, you want to move 4 funds into one fund, or the other 4 funds into one fund. What you can look at here is the exit fees. Okay, are there any exit fees? Because some funds do charge an exit fee. It could be as little as $50 or $100, but it is something you need to be aware of. Also, insurances. Before you close a fund, make sure that you have adequate insurances. You don't want to close all your funds. Potentially, you might actually have a fund that doesn't have any insurance, and if you don't have any insurance policy or you're not covered, then you might be out of pocket if you have to make a claim when you've cancelled all your insurance policies. The other thing to consider also is super scheme. Okay, what type of super scheme does someone have? So what is it that you're basically receiving within your fund? Some funds are what they refer to as accumulation funds, and others are defined benefits schemes. So a defined benefit scheme is a fund whereby their final balance is dependent on your contribution, but also your employer contribution. Okay, your employer may actually be contributing for your retirement. So with these kind of defined benefits, the end result can be very beneficial when you eventually retire. So exiting from these funds may cost you in the long term. So when we ask clients what kind of funds they have, we'll ask them, is it a defined benefit or is it accumulation? And accumulation, on the other hand, it's a fund where the final balance is only essentially what you contribute or what your employer, that 9.5% each year, is contributing. It's the final amount plus the investment earnings over the time. So when you essentially decide to retire and generate income, whatever the balance is, that's what you generate income from. With a defined benefit, you have the additional benefit of longevity. You reduce longevity risk, which means that although your money might have run out with a defined benefit scheme, the employer will have to continue paying you an income stream. So they are more advantageous. So before you move funds, we need to understand the consequences of closing a fund or consolidating funds. The other one is comprehensive advice. Most superannuation funds will offer you a service to either provide you limited advice. For example, industry funds can give you what they call intra-fund advice. Advice about what you do between the funds. So it could be switching, or it could be making a salary sacrifice contribution, or it could be effectively going from accumulation to an income stream. So they are limited in the context that they're only talking about their fund only. But these companies may also offer you comprehensive financial planning advice, which they would consider other aspects of your financial planning needs. So it doesn't have to be just superannuation. It could be investing to borrow money into property or into shares or estate planning. So there are a wider scope of advice that you can give. So when you're looking at leaving a particular fund or a company, make sure that the new fund that you move into provides you the type of advice that you actually need. Okay, so whether it will be limited advice, scaled advice, or comprehensive advice. Okay, again, just contact us if you need to know more information about the differences and what you get, and also what you're paying for. The other one is other benefits. So there could be other benefits that the fund offers you. So as we mentioned before, other benefits could include a defined contribution, and other benefits can also include a better service by the provider. Or other benefits can also include a risk-free income stream when you retire. So each fund scheme will have different rules and regulations, so depending on the trustee and the product disclosure statements. Okay, so other benefits could include some funds provide you a good scope of investment options that relate to maybe a religious belief, or it could be something like an ethical fund. So these things are important to consider. Okay, so let's look at the next one. Have issues with that. So these are new rules from 1st of May or July 2019. Let's cover the first one. What does insurance opt-in mean? Okay, so this is very important to consider because this will have a significant impact on your wealth, your livelihood, and also your future income. So the first one is insurance opt-in. So from 1st of November 2019, any inactive fund. Okay, what does an inactive fund mean? An active fund, by definition, is a fund that has not received any contribution in the last 16 months. So a contribution could be a personal contribution or an employer contribution. That means that the person who has not received an insurance contribution within the last 16 months, they have to opt in to keep their insurance policies. The insurance policies could be, which are mainly life insurance cover, total permanent disability cover, and also income protection cover. Now, from 1st of April 2020, okay, this is very important. From 2020, if your balance is less than $6,000, you have to basically opt in to continue receiving insurances. Okay, so the super fund trustee cannot automatically deduct insurance based on the default scheme. Okay, so remember, as a complaint that the industry has had over the years is that insurance was offered to members that were not aware that they were actually paying for this insurance from their own retirement savings, and over time their superannuation had been depleted. So this was one of those significant changes that the government introduced under the Protect the Young Person members legislation. So the other one is inactive accounts, so which is balance less than $6,000. So after 1st of July 2019, as we said, inactive accounts basically were accounts which had less than $6,000. Okay, but also for existing members, an inactive account was for an account that essentially, or as someone who's under the age of 25, was regarded as an inactive account. Okay, now for existing members, an inactive account, if someone had less than $6,000, their accounts, the insurances were effectively cancelled. Okay, so let's have a look at the next one, which is caps on fees on low balances. Again, this was part of the review of superannuation funds and protecting members' interests first legislation. The fees on low super accounts was effectively protected. So any balance under $6,000 or low balance was limited to no more than 3%. Okay, so the fees that they look into taking into consideration is administration fee, investment fee, and also indirect costs. They must remain under 3%. Okay, again, this protects members who've got less than $6,000. And the last point there is exit fees. Okay, with the exit fees have been essentially banned. Okay, so you can't charge a fee when you switch between one fund to another. So if you want to move your money from Fund A to Fund B, if there was an exit fee, that the fund can no longer actually charge you that amount of money. Okay, so again, this looks at protecting superannuation balances. Okay, so let's have a look at the last one there. And I just wanted to sort of finish off with this slide in terms of the benefits you get for actually getting personal financial planning advice. So we encourage you to contact us on 1300 855 017. The important thing here to remember is that when you're getting advice from a person who's not linked to a product provider, okay, it does not work, for example, for a large corporation or a large bank, and who essentially is looking at your interest only. Under corporations law, financial advisors must act in your best interest, okay, and must actually conduct adequate research when switching your fund or when assisting you to decide on which of your funds you want to consolidate your money into. Now, the benefits of obviously getting advice here is that you're receiving a professional service, and as advisors have to also carry professional indemnity insurance. We do act in your best interest, so it's not about what product we choose. It's all about strategies, and does that strategy or does that product actually meet your needs? Okay, does it put you in a better position? Are you better off by taking this advice? So these are the benchmarks and measures that we have to consider. The other one is we're not product aligned. Okay, so we have what they call an open approved product list. Okay, so we can choose any fund we like as long as we've conducted our research and the fund is in your best interest. Okay, and we're not taking any undue risk in choosing these funds. So we are not tied to any particular bank or corporation. And so therefore, it just means that our advice is not conflicted, or, nor is it biased, or is it limited. Okay, the other one is strategy focused. Now, as financial planners, all financial planners, they have to have a degree and also sit a centralised exam and be members of FASIA and be effectively keeping up their professional development. At Bamboo Wealth, I am fully qualified. I hold a Master's Financial Planning. I'm a certified financial planner. So that gives me the knowledge and the strategies to effectively provide you advice. So we don't just look at one individual needs, although if you want, we can, but we look at comprehensively what impacts our advice will be, not on you today or for your retirement, but also for your family, your extended family, or other members of your relationships. And we also look at succession planning. One of the first things we consider outside your investment objectives is how can we protect your future needs, your future income, and your family. So that incorporates things such as understanding if you need a will, if you have a self-managed super fund, who will be successive trustees, and also aged care. So we also qualify in providing aged care, so we can discuss your next generation transfer of wealth. And as I said before, our advice is unbiased. And what unbiased means is that we don't choose strategies or products that put our interests first. We actually are focused on making sure that you are benefiting from the strategies that we provide you. So if you don't, essentially, I'm not put in a better position that then as an advisor, have not actually done our professional duty of care. Okay, so if you want to know more about superannuation, please contact us. We also have some fantastic financial literacy booklets. We have our educational ebooks, 5 of them, depending on your life stage. So we are here to help. Contact us on 1300 855 014 and also on mobile 0432 588 017. And we hope you enjoyed this short presentation, and we look forward to working with you in the future and bringing you more presentations such as this. Thank you. See you next time.